take his fucking money and run home. You don't let him do that. Okay. Because that would make it real. Right. No, what do? You get another brilliant idea. A special idea. Another situation, another stock to reinvest his earnings and then some. And he will every single time because they're fucking addicted.
And why listening to finance YouTubers could potentially be the worst decision of your life. I'm not kidding. Certain predictions, such as what stocks are going to 10x in price, can really influence what their audience does with their money. And honestly, I wouldn't be surprised if buying stocks that YouTubers tell you to buy is actually a common investment strategy for a lot of people today. But doing this can be a very bad idea. Return of minus 53%. So for someone that actually sells memberships to his own private stock group, this isn't really the best look. It turns out his group probably isn't the blueprint to long-term investing success. It's more like the blueprint to losing half of your investment.
Are you an investor or a gambler? Investing versus speculating. Investors make decisions based on the facts and the value of the asset. Speculators make decisions based on other participants' behaviors. Know the difference. Benjamin Graham said, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Good business versus bad business. Now you probably know Tesla is a good business. Tattooed Chef is a bad business. But why? Graham defines in simple terms what makes a business good. The inverse of these conditions makes it bad. Investors should focus on buying good businesses. Ben Graham said, good businesses are generally considered those with strong barriers to entry, limited capital requirements, reliable customers, low risk of technologicals, obsolescence, abundant growth possibilities, and thus significant growing free cash flow.
How you like that? How you like that? Nah. Look at you, now look at me. Look at you.
AI hypertrain is over. Watch out next week. Taiwan Semiconductor Manufacturing Corp executives may have slapped down some of Wall Street's euphoria over artificial intelligence reflected in the recent run-up in the stock prices of several chip makers, with cautious comments about the sustainability of the current demand for AI chips. TSM stock, currently the world's largest contract manufacturer of semiconductors, acknowledged in its earnings call with an analyst that there has been strong demand for processors related to AI, especially in the data center, but they added that it is not clear how sustainable that demand will be. It also said AI would not offset the current sluggish demand for semiconductors. The short-term frenzy about AI demand definitely cannot extrapolate for the long term. TSMC Chairman Mark Liu told analysts on a conference call, neither can we predict the near future, meaning next year, how the sudden demand will continue or will flatten out. TSMC said AI-related processors currently account for 6% of its revenue, but it was not enough to offset the overall macroeconomic impact of the current downturn in demand for semiconductors and is forecasting its full-year revenue to be down 10%. It said that AI processor demand could grow at about 50% on a compounded annual growth rate for the next 5 years. The company also pushed out the production start date for its new manufacturing plant in Arizona to 2025, saying it was having a hard time getting skilled workers for semiconductor equipment installation, and it was sending experienced technicians from Taiwan to train local workers for a short period of time. Management has run its own models and projects a 50% CAGR for its AI revenue and expects it to reach low teens percentage of the total revenue by 2028, said Needham Incorporation analyst Charles Shi in a note to clients. No more details were given on the assumptions behind the 50% CAGR projection. Several semiconductor stocks fell in reaction, including shares of high-flying NVIDIA Corp, which is currently one of the biggest early winners in the AI arms race. The company makes graphics processors, GPUs, designed to run compute-intensive AI applications, and they have become even more in demand in recent months since ChatGPT was launched late last year. NVIDIA forecasts that its fiscal second quarter will see a huge boost in AI demand, forecasting around $11 billion in revenue, a record high for the chip designer, while TSMC executives also said the demand for generative AI applications, such as ChatGPT, will also increase capital spending. Investors were instead likely focused on the fears about current sustainability and the company's view on the overall global demand for semiconductors. The company's outlook has deteriorated versus 3 months ago, largely driven by reduced optimism around macro trends, weaker than expected China recovery, and ongoing customer inventory digestion, said Evercore analyst CJ Muse in a note to clients. The bad news, good news scenario from the world's largest semiconductor maker indicated that the chip downturn may not be over, and that AI is not the ultimate savior that some might believe. I appreciate you joining me today. Next week is going to be crazy.
Watch out, here's the schedule. Cheers!